When you look at the theme of the conference, from recovery to reform, stop the bleeding, cease in the otuko, I think we are basically spot on in terms of the extent of the challenge that we face and the need for us to actually take action. The concept note itself goes to town to explain in reasonable detail the extent of that challenge and the possible solutions that we need to be looking at. And I like the expression by the Vice Chairperson of the board, dismantling the architecture. I think that's what we should be saying. I share with her those revolutionary views, if that is what we should be calling them. And I think that this way of approaching things is overdue. We cannot afford to be, complacent anymore. I think that we should actually be talking in terms of the language such as the one that the Vice Chairperson of the board was using. I do not want to reiterate everything that has been said in the concept note, but I've picked a few things. I think I've picked 5 things from the concept note that I would like to highlight by way of setting the tone for my paper. The first of those 5 things is that African economies are actually weak and vulnerable to both internal and external shocks. This has been illustrated in the way in which the economies have been impacted on and responded to the COVID pandemic, in spite of the incidence of infections being in the region of about 3% of the global total infections, and deaths being the region of only about 4% of total deaths arising from COVID. We have seen a huge impact on the economies of African countries as a result of COVID, including the fact that many of them have actually had to report negative growth rates in the period from 2020 to 2021. And this is additive to the fact that these economies are also impacted on very severely by climatic change-related shocks, which remind us year in, year out about these vulnerabilities. Yet I think that we don't do enough to recognize that we have these extensive vulnerabilities that we should be doing something about. The second major takeaway that I draw from the concept note is that the capacity of the continent to recover from these shocks is very, very weak. And because of that weak capacity to recover from these shocks, the effects of those shocks tend to exaggerate, to enhance, to accentuate the economic challenges that we face as a continent. And those challenges are quite obvious. We're talking about weak fiscal positions, a compromise on the ability or capacity of state governments to deliver on public purpose, weak trade positions, macroeconomic instabilities, poverty, and general social insecurity. The third takeaway that I'm drawing from the concept note is that the structures of African economies make it impossible for them to actually respond to those shocks and to recover from those shocks quickly enough and sufficiently enough without recourse to external assistance. And the point that I want to emphasize here is that it is virtually impossible for most, if not all, African countries to address these challenges as we speak now without recourse to external assistance. And because of that need for recourse to external assistance, the fourth observation that I'm making on the concept note that has been drawn is that Africa, therefore, as a result, faces a persistent need for more debt. And that is because the global debt architecture is structured to perpetuate dependence. It is structured to perpetuate the dependence of African countries or African economies on this global debt architecture, which, like we seem to be agreeing now as resolution number 1, instead of talking about reform, we should be talking about dismantling. And African countries are being forced to become dependent perpetually on this external debt, in spite of the fact that the terms associated with contracting that debt increasingly become unfavorable to debtors and more favorable to creditors, like has already been highlighted. The result of this is that there is now a new spiral of unsustainable debt that is emerging on the continent, and this is the case even after most countries benefiting from the heavily indebted poor countries initiative, as well as the multilateral debt relief initiative. As we speak now, the numbers seem to be suggesting that African debt has just recently surpassed the $1 trillion mark. And that's huge. The other point that is associated with this persistent dependence on debt is that there is therefore increasing or rising debt servicing costs that African countries have to pay. And because of that, there is a natural limitation on the fiscal space that African governments have and a direct limitation on the ability of those African governments to finance development. There are indications that are countries that are actually spending up to 1/3 of their recurrent budgets on servicing debt, both domestic and foreign debt. There are countries that are lower than that, but in general, these resources could have been channeled to more productive uses in these parts of the continent than is actually the case at the moment, and we should be concerned. The fifth and final key observation that I'm making on the concept note is that, and has already been highlighted, it is very necessary for us. In fact, it's a calling on our part. We don't have a choice but to interrogate and champion a dismantling of this global debt architecture in order to reverse it in such a way that debtors have as much of the voice in the contracts as creditors, perhaps even, if not more of the voice than the creditors themselves, who have, over a period of time, at least since the 80s, milked and benefited and sucked our continent to a point where they have profited many, many times in percentage terms. It is against this background that I'm giving you now that I would like to contribute to this discourse by talking about the political economy of debt in Africa. Because I think in order for us to be able to understand the extent of the challenge that we face, we need to have a comprehensive picture of where we're coming from, why we are coming from there, and why we find ourselves where we find ourselves now, and therefore how difficult it will be for us to dismantle this architecture. In my opinion, that difficulty perhaps exceeds the challenges that we faced with respect to the attainment of political independence. In order for us to do this, and indeed in order for me to share with you my thoughts on the subject, I have developed 4 propositions. And I would like to share with you 4 propositions that are the basis of my contribution to this discussion. Proposition number 1 is that we need to appreciate that debt is inevitable. It is not possible for us to imagine a situation where any state or government can run its operations without debt. But while appreciating that debt is inevitable, therefore the questions that we must be asking ourselves as we seek to dismantle this architecture is that how it is being used, where it is coming from, and the terms that are associated with that debt matter a lot. And to add stuff to this proposition, I would like first of all to share with you what standard theory says. Standard economic theory says that when you look at the spectrum of economic agents in a country, the household sector of the economy is a saving surplus unit. It is households that own companies. It is households that, in general, on the aggregate, consume less than what they earn, and therefore channel resources to other agents of the economy. From that perspective, the other agents of the economy, namely the firms and the government, are saving deficit units. It is inevitable for you to see a situation where a government consumes more than it actually generates in the short run over a given period of time. Therefore, debt is inevitable. The significance of debt is also strongly highlighted in developmental state theories. When you look at the work of people like Keynes, the general theory of employment, income, and wealth, when you look at the work of Lehner, 1943, when you look at the work of Doma, 1957, and Armstrong, it is very, very clear that it is hardly imaginable that a government can achieve growth and sustain development without debt. The literature actually makes it very clear that nothing is characteristically bad about government borrowing. It makes it very clear that in an ideal situation, macroeconomic policies must reflect pragmatism rather than a religious adherence to some ideology. The literature is very clear that inflation in a country generally reflects the deficiency of output relative to demand. That it is therefore important for us to recognize that while people like Irving Fisher emphasize that inflation is caused by a scenario where too much money chases too few goods, it is in fact also possible, and perhaps even more important, to recognize that inflation will occur if you have too few goods for the available money, and therefore the economy must be stimulated in order to close that gap and address an inflationary challenge. When you look at that kind of thinking a little more critically, you will actually see that the excessive aversion to public debt, too much emphasis on austerity, may actually lead to bad policies. The criticism that is leveled against governments, and in particular against deficit budgeting, is worrisome because it poses a limitation or imposes a limitation on the ability of the government to deliver on public purpose. However, while we locate that debt is inevitable and important, we also must recognize that debt is important to the extent that it finances productive expenditures. The neo-Keynesian framework that talks about expansionary fiscal policy assumes that governments will be able to balance their recurrent budgets and borrow for development. When you have a situation where the reverse is the case, then you have serious problems, because expenditure on the development component of the budget with borrowed money expands the capacity of the economy to grow and therefore to service debt in subsequent periods. And to give you more evidence of the importance of debt, let me share with you some statistics. The United States of America had 105% of its GDP held in debt in 2018. So in 2018, the debt position of the US government was 105% of GDP. Because of COVID and other factors, that has increased to about 124% of GDP by 2021. Okay. When you go to the UK, debt was in the region of 83.5% of GDP in 2018 and increased to about 96% of GDP in 2022. The US government debt position is in the region of $30 trillion as we speak. The UK government's debt position is in the region of 2.3, 2.5 plus or minus trillion pounds sterling as we speak. These economies could not have achieved development without debt. But the debt position in sub-Saharan Africa was in the region of about 47% of GDP in the same 2018, by way of comparison, and is only in the region of about 57% of GDP in terms of 2021 numbers. Yet, in spite of the observation that all governments contract debt, it is only the debt burden of developing countries that is highlighted. In spite of the fact that debt exceeds the GDPs of developed countries in certain cases, it is only the debt of developing countries that is the subject matter of global discourse. And there could be a reason for that. The reason is that we then have to look at the sustainability of debt. Even though the literature and the arguments and the discourse on the debt sustainability issue varies from place to place, the academic literature, which I would like to believe in because I believe I belong there, says that debt is only sustainable if its present value, its value in the present period, does not exceed the discounted value of future surpluses. Therefore, the reason why we should be concerned about debt is that we perhaps do not have the capacity to generate surpluses in future periods. If you have governments that are perpetually running deficits on their budgets, they should actually not even be contracting debt. And I'll be talking about these things as I go along, because the framework itself, which we must be dismantling, generally makes it impossible for us to grow our economies and our tax bases to be able to have sustainable debt. And because we cannot contract sustainable debt on the basis of what we should be contracting it on, a different way of ensuring that we continue to contract debt in spite of the fact that we don't qualify for it is put on the table for us. So our space for contracting debt is therefore assessed in terms of what is referred to as the primary fiscal deficit or surplus. Instead of simply looking at the deficit in terms of the difference between revenue and expenditure, the primary fiscal surplus looks at revenue minus expenditure plus debt servicing as space for us to continue to borrow. And that entices us. Dangles a carrot for us to continue to borrow when our economies are not growing and when the debt therefore becomes unsustainable because we don't have the capacity to record surpluses on the budget. Another point that I want to talk about on this proposition is therefore that we need to look at the reasons for which we are borrowing very, very critically. Remember I said source, use, and justification, right? We have situations where debt is contracted for consumption. In many cases, African governments are borrowing in order to give out social cash transfers. African governments are borrowing in order to subsidize consumption, production for consumption in the short term. When, like I said earlier on, you can only justify borrowing on the part of the state if it is going into investment as opposed to consumption. HIPIC countries that qualified for HIPIC, are now in situations where they are borrowing more unplanned debts than non-HIPIC countries. because the non-HIPIC countries were already in stronger positions than HIPIC countries, and therefore HIPIC has not strengthened the capacity of its beneficiaries to graduate from excessive dependence on development assistance. And finally, we must be concerned, and I hope that the conference will actually discuss this point, that national capacities to actually assess debt are weak. And therefore, external debtors come to us and impose on us to borrow for purposes that we would otherwise not be borrowing for if we had conducted extensive analysis internally. So that's my first proposition. Debt is inevitable, but how and why and in what form you're contracting it matters. The second of my 4 propositions is, if we want to agree to call a spade, and I hope that you want us to agree to call a spade and not a big spoon, then debt is a key instrument for the perpetuation of colonization in Africa. It is perhaps the single most important variable that has impacted on the way in which neocolonialism, if that is what we want to call it, has been entrenched on the African continent. And I want to give you a bit of history here in terms of where we're coming from. When the Bretton Woods institutions were established, we know that their main clients were actually their founders, the industrialized or the developed world. They are to address the need for exchange rate alignment as a result of the end of the gold standard, the need to provide short-term lending in order to address balance of payment challenges, and the need for surveillance as a result of providing that kind of assistance. The World Bank was established in order to finance the reconstruction of Europe at the end of the Second World War. So these are the main reasons why these institutions were initially established. And their clients, therefore, at the point of establishment, were the founders themselves. But the founders reached a point where they no longer needed the IMF and the World Bank, because reconstruction had been achieved and because they had strengthened their economies to a point where they needed no lending from, or borrowing rather, from the IMF. And definitely the end of the gold standard in 1973 made it unnecessary for exchange rate realignment of the type that was necessary in the context of the gold standard. Therefore, these institutions, the so-called Bretton Woods institutions, found themselves in a crisis of purpose. They found themselves in a situation where they were no longer globally relevant. And the question had to be answered as to whether they should continue to exist or they should reform themselves in such a way that they continue to remain relevant. And there is literature in this regard. I can mention that to you if you want. In order to give you evidence of this irrelevance, the IMF's loan to the United Kingdom that it extended in 1976 was the last loan that it had ever extended in that period until Ireland required recourse to the IMF in 2008. Since then, the industrialized world generally, except for COVID and other interventions, has not had recourse to the IMF. So the work of the IMF and the World Bank generally was done until a new purpose had to be found in order to perpetuate their existence. And that purpose was found in the fact that as a result of the global recession of the 1970s, African countries found themselves heavily indebted to Western creditors, private Western creditors, northern banks. Some estimates indicate that African debt reached 500% of the continent's export earnings by the late 1980s. And therefore, following this crisis, 1970s and 1980s, the Bretton Woods institutions almost exclusively redirected their operations, their focus, to developing countries. They then became collection agencies, data collection agencies for the founding Western creditor countries, and therefore started making African countries repay their debt by giving them loans that would allow them to repay those debts in return for reforms. In the literature, because you now have a situation where public debt is being handled more privately, the discourse centers on the privatization of public debt. And that has been a very, very big challenge. In order for the World Bank and the IMF to do this, they had to influence the way in which African economies are managed. And the linchpin of the work of the Bretton Woods institutions was what is referred to as the Begg report that was written in 1981. Begg was a World Bank economist who wrote a report typically referred to as the Begg report, which did at least three important things. The first of those three things is that it attributed the economic problems of Africa to the continent's failure to manage their economies efficiently. So Begg said, no, you are in this situation because you are not managing your economies properly. The second observation that Begg made in that report was that there was need to set out what was called the structural adjustment of these economies. So it is on the basis of the Begg report that African countries therefore adopted the structural adjustment policies. But when they did that, and this is a point that I'll come to at a certain point, they were ignoring and putting aside another tool that had been put on the table for them earlier, what is called the Lagos Plan of Action, which was a homegrown, continentally homegrown solution to the challenges that the continent was facing at that time. The third point that the Begg report emphasized on is that, even though perhaps it may not have come out very clearly from the Begg report at that point, the third point that I want to attribute to the Begg report is that the report became a consequential entrenchment of neoliberalism in Africa. It is because of the Begg report that Africa actually moved to neoliberalism. With this newfound relevance by Bretton Woods institutions, the Bretton Woods institutions became the most dominant voice in shaping Africa's economic management and development. In fact, the World Bank and the IMF, especially the IMF, is more important and more strong in deciding how the economy should be managed than the people we elect to manage the economies for us. Which means, therefore, that the adoption of the Begg report and the entrenchment of Bretton Woods institutions in economic management reversed this role of the state in managing the economies and actually delegated that function to foreigners. In another presentation that I made some time back, I actually said that the risk we ran, therefore, at that point is to delegate our economic management function, which is a very important function. The reason for which we elect people to go into office is to manage our economies under the social contract. But what we did here is to delegate this function to the descendants of colonialists and slave traders. We know the main reason for which the Bretton Woods institutions really continue to persist in influencing African economies. The stated goals at their point of entry were to set prices right and to set institutions right. And that has always been the case. Set prices right and set institutions right. But the question that we have never answered is, for whom are these prices and institutions generally being set right? The ultimate goal of the Bretton Woods institutions is to save the interests of Western transnational corporations. They do that, they save those interests by ensuring that African economies present investor-friendly environments, that African economies are characterized by declining wages, therefore the cost of labor becomes low, that African economies do not have capital controls so that the inflow and outflow of capital is easy, and they do so by entrenching export-oriented growth strategies, even in economies that are incapable of producing and exporting anything. In the process, therefore, worsening the balances of payments of these economies. Another point that I want to make about the entrenchment of continued colonization is that the African countries' debt as a result of taking advice from Bretton Woods institutions has only gotten worse. We know that the scheme culminated into the bailing out of northern commercial banks by northern taxpayers. So the taxpayers put money into the kitty, that money is transferred to African economies, and the northern banks get their money back, and African economies have to pay the Bretton Woods institutions in manners and under terms that are very, very difficult for the economies to actually sustain. That's my second proposition. And to summarize, debt is an instrument for the continuation of colonization in Africa. My third proposition is that Africa can never avoid the debt crisis without focusing on growth. It is not possible for African economies to actually come out of the debt crisis, whatever we're going to talk about, to the extent that we are going to put aside the significance of growth. We must forget our ability to come out of the debt crisis. Yet, in spite of this stylized fact, the neoliberal machinations, the system itself, systematically results in a framework that makes it impossible for African governments to focus on growth. In the 1970s, neoliberalism led to a situation where African academics and policymakers began to despise development economics and the role of the state in development. And there is work that attests to this. Thandika Nkandawile has written extensively to this. Therefore, attention was diverted to focusing on short-term macroeconomic stability. The short-term objective of policy has therefore been macroeconomic stability, and growth has been relegated to the long term. Unfortunately, most African economies have been stuck in that short term since the introduction of neoliberalism. So this is a short term that for most countries has been running for about 40 years. Up to now, we're still talking about focusing on macroeconomic stability. And in recent times, I think we should recognize that one of the important instruments that neoliberalism uses in order to manage the economy is the central bank. And when central banks were being formed in the 60s, 70s, and thereafter, they had an important developmental role to play. In recent times, The move has actually, gone to the extent of making it very clear that central banks should no longer focus on growth. That if there is a conflict in the conduct of monetary policy between growth and price stability should be pursued even if it is going to dampen growth. So we have put the real sector aside and put the financial sector ahead of us, because it is in the financial sector that neoliberalism has most of the interest. And you can actually also look at that and say that because we are not focusing on growth, because we therefore have to invoke contractionary monetary policy perpetually, we have a vicious cycle. We have a situation where we have to continue to borrow because we are not growing and therefore we're not broadening the tax base. And because we are not broadening the tax base and we have to continue to borrow, we can't grow. Okay. And that has been our dilemma as a continent over a long period of time. And I would like to say a little more about the orthodox conduct of monetary policy. One thing that I want to emphasize here is that the orthodox conduct of monetary policy positions domestic capital as bad. It is called excess liquidity that must be mopped out of the system. The economy does not have the capacity to absorb that excess liquidity, and therefore it must be mopped up from the system and be locked up in the central bank. And if you ask many people out there whether they can put extra money to good use if it is being given to them at a good interest rate, the answer for most of them is going to be yes. But the neoliberal model says that domestic capital is bad and it must be mopped up. But foreign capital is good. Foreign direct investment is good, and it must come into the domestic economy in order to facilitate technological transfer, in order to ensure that it closes the gap in the inadequacy of capital arising from mopping up excess liquidity. What this does is to relegate domestic citizens who are incapable of borrowing at very high interest rates to perpetual suppliers of labor. They cannot own tangible and profitable investments. Instead, because it is encouraging foreign direct investment, it is also perpetuating illicit financial flows from African countries. The evidence is very clear that most of the illicit financial flows that are taking place in Africa are being done by transnational corporations, and therefore foreign direct investment. So encourage foreign direct investment, but as a result of encouraging foreign direct investment, the result is illicit financial flows, which are being worsened by increasing investments in the extractive industries where we have very limited knowledge, and many other sectors because we are incapable of actually taking charge of what is happening in transnational corporations. And some of the evidence seems to suggest that the loss that African countries are incurring as a result of this phenomenon, illicit financial flows alone, exceeds the totality of official development assistance and official aid for some of the countries. Which means that it is possible actually for these countries to graduate from dependence on debt or aid if illicit financial flows were controlled. But illicit financial flows will never be controlled because the model is structured in order to entrench the operations of transnational corporations. The high illicit financial flows obviously mean tax base erosion. It means slow revenues being collected by the state. It means borrowing. Okay. If your revenue base is very narrow, because Africa is a leaking basket or bucket, if that is what you want to call it, your need to borrow will continue to rise. And that need also rises because in the model, when you look at the totality of the structure of the model, African governments are being loaded with more and more responsibilities, and in particular, mostly responsibilities that do not contribute to production. The other thing that must be said about illicit financial flows is that because foreign direct investment that came in to grow economies is also coming out of those economies illicitly, total investment capital is declining. And the economies are also slowing down as a result of that. The tax base is also being narrowed, and therefore more need for governments to borrow. Therefore, my proposition once again is, if you are not going to focus on production as domestic economies, as African governments, if you are going to continue to believe in a message that tells you that growth must be relegated to the long term, and that in the short term, which has persisted for more than 40 years for most economies, the short term should only focus on macroeconomic stability, forget about graduating from dependence on debt. An economy that doesn't produce anything is basically doomed before it begins to work. My fourth and final proposition is that it is time for us for a Lagos plan of action type of approach to African debt. The neoliberal model is tired. It is tired, but it only survives because of strong vested global interests. The focus of the neoliberal policy reforms is actually inappropriate for Africa, because the initial arguments that African governments used in order to have mixed economies, an economy where the government plays a leading role, not only as a referee but also in production, smallness of the private sector, etc., etc., those arguments are still valid today as we speak. And there is evidence, there are papers that I can share with you in that respect. The other reason why the neoliberal model is inappropriate for us is that the underlying behavioral relationships that are the building block of the neoliberal model do not necessarily exist in African countries. I'll give you an example. In order for you to have a neoliberal model that really operates and entrenches the operations of free markets, you need to have a treasury that does not borrow irresponsibly. Because if the treasury borrows irresponsibly and the regulator is weak, too weak to control fiscal dominance, then you have a situation where the banking sector simply sits down and channels all its resources to the public sector. And in the literature, there is an argument that if you have banks that simply mobilize resources from savers and channels them to the government, those should be called non-banks. But that's what our banks are doing. They can simply sit in their treasury posh offices and decide how treasury bills are moving on a daily basis, because the governments have insatiable appetites to borrow. And they have those insatiable appetites to borrow, not out of choice, but because, like I've already said, the framework is set in such a way that it is impossible for them to broaden the tax base in order to generate adequate resources for their own expenditure needs. One of the authors that I have encountered has actually made the point that the neoliberal model is one of the most powerful concepts to have emerged within the social sciences in recent times, which endures despite being ideologically exhausted. And it endures because there are strong vested interests that are backing it. When we had the global financial crisis in around 2008, 2009, governments injected liquidity into the systems in order to bail out economies. When COVID started in 2019, Germany alone is known to have injected, if I remember very well, something in excess of 30% of its GDP to counter the effect of COVID. Governments have a very important role to play in every country in the world where development has been achieved, except in countries that think that their solution resides in the households of the descendants of slave traders and colonialists. Like I said earlier on, the Berg Report of 1981 thwarted Africa's opportunities for attaining self-sufficiency through the earnest implementation of the OAU's Lagos Plan of Action for the Economic Development of Africa for the period 1980 to 2020. The Lagos Plan of Action, as we look at it now, correctly predicted the adverse effects of neoliberalism on Africa. It did, very perfectly. And it said the solutions to our continental challenges can only be inward rather than outward. The Lagos Plan of Action offered comprehensive solutions to Africa's debt crisis of the 1970s and the 1980s. But the continent disregarded those recommendations for its own doom. It chose doom rather than growth and development. For abandoning a timely homegrown solution, Africa, collectively, must bury its head in the sand, in shame, because the solutions were put on the table for us. But we're enticed by a carrot that looked sweeter, when in fact it was bitter, and that bitterness finds ourselves in a situation where it is difficult to extricate ourselves without invoking anything in the region of a revolution at a continental scale. In order for us to dismantle and reconstitute the global debt architecture, monetary and fiscal policies must be redirected to recognize that macroeconomic instability, inflation, external imbalances, these reflect deficient aggregate demand. And the solution is not to worsen the situation by making it impossible for people, for domestic residents to borrow. There is now increasing evidence that suggests that the solutions to Africa's challenges reside in Africa. They do not reside anywhere else. But as it has already been mentioned, it will require a collective effort on the part of African countries, a collaborative effort on the part of African countries to surmount this challenge. Individual African states that have actually tried to resolve these challenges for themselves have actually faced dire consequences, and the rest of Africa has sat back and watched them as they suffer. They have suffered in isolation, instead of the rest of Africa coming together and saying, exactly, wait a minute, what are we doing to our colleagues? And I would like to put adequate emphasis on this point, that it will take no less than the type of continental revolutionary wave that led to the independence of African states in the 1950s and the 1960s and beyond in order to resolve the challenge that we face. We need a forceful continental coalition of the willing within what I would describe as a whole of continent framework, a whole of continent framework to create a continental critical juncture. When structural adjustment policies were being adopted in the 1980s, a critical juncture had been invoked. We have run that experiment long enough to know that it is leading us nowhere. But I also want to say this, as I get to my conclusion, that a lot of talking is being done on this subject. But the evolution of a necessary collective political leadership and political will to address the challenges seems to be lacking. So there will be isolated political leaders here and there that are trying to do the right thing. But if no collective political leadership and political will is being seen of the scale that helped African countries to gain independence, we are going nowhere. I know that members of parliament, and thank you, Chairperson of Budget and Finance, for being here, are talking about these things. I know that civil society organizations are talking about these things. And we, in my experience in the Treasury, we have been talking about these things with fine minds and people that care. But unfortunately, talking alone does not address the problem. Following this talking with action is the only way in which we can extricate ourselves from looming doom. And I want to lay due emphasis on this final statement that I would like to make, which is that development is always and everywhere a leadership-driven process.
We call for policies and practices that put people first. We call for policies and practices that put people first. You and I are the people.